Hey guys, welcome back to another episode. In this video we will be going through our very simple yet profitable support and resistance trading strategy. As usual, we'll have plenty of practical examples. The idea is to fully understand this wonderful trading strategy and to make the most out of it. If you want more videos more often, please smash the like button, subscribe, and turn on the notifications bell so that you know exactly when new content is released. And don't forget to share this video across your WhatsApp, Facebook accounts, or Twitter to show your support. A very important point before we start. Everything we discuss in this video can be used for currency trading, stock trading, and crypto, because price action stays relatively consistent across different assets, so we're going to go very in-depth in this video. The most effective support and resistance trading strategy that lets you profit from losing traders. The concept of support and resistance is a cornerstone of price action trading. The concepts of trading level support and resistance are undoubtedly two of the most highly discussed attributes of technical analysis. They are used in designing a trading strategy as guidelines for price targets, entry points, exits, and stops. So in this video, you'll learn everything you want to know about support and resistance trading strategy that lets you profit from losing traders. Specifically, here's what you'll learn. First, the 4 things about support and resistance that losing traders are not aware of. Second, how to find favorable risk to reward trades. Third, how to tell when support or resistance will break so you don't enter trades at the wrong time. Fourth, the most effective support and resistance trading strategy that lets you profit from losing traders. Are you ready? Then let's get started. The 4 things about support and resistance that losing traders are not aware of. First, support and resistance are areas on your chart and not lines. Why support and resistance are areas on your chart? Because of these two groups of traders. First, traders with the fear of missing out, or FOMO. Second, traders who want to get the best possible price, or cheapo. Let me explain. Traders with the fear of missing out would enter their trades the moment the price comes close to support. And if there's enough buying pressure, the market would reverse at that location. On the other hand, there are traders who want to get the best possible price, so they place orders at the low of support. And if enough traders do it, the market will reverse near the lows of support. But here's the thing. You've no idea which group of traders will be in control, whether it's FOMO or cheapo traders. Thus, support and resistance are areas on your chart, not lines. In this video, I've included a template with the system that you can simply upload to your chart, and it will automatically plot all these indicators perfectly on your charts, so there's nothing for you to worry about. Get the download link on the description. Second, support and resistance can be dynamic. What you've learned earlier is horizontal support and resistance, where the areas are fixed. But it can also change over time, otherwise known as dynamic support and resistance. And now, there are 2 ways to identify dynamic support and resistance. First, moving average. Second, trend line. Let me explain. First, moving average support and resistance. How to use the moving average to identify dynamic support and resistance. I use the 20-period and 50-period simple moving average to identify my dynamic support and resistance. Here's an example. However, it's not the only way. You can use 100-period or 200-period moving average, and it works fine. Ultimately, you must find something that suits you and not blindly follow another trader. Second, trendline support and resistance. These are diagonal lines on your chart to identify dynamic support and resistance. Here's what I mean. Pro tip: treat support and resistance as areas on your chart and not lines. This applies to both horizontal and dynamic support and resistance. Third, the more times support or resistance is tested, the weaker it becomes. First, let's define support and resistance. Support, area on your chart with potential buying pressure. And resistance, area on your chart with potential selling pressure. Here's an example. And now, you've probably read trading books that say, the more times support or resistance is tested, the stronger it becomes. But the truth is, the more times support or resistance is tested, the weaker it becomes. Why? The market reverses at support because there is buying pressure to push the price higher. The buying pressure could be from institutions, banks, or smart money that trades in large orders. If the market keeps retesting support, these orders will eventually be filled. And when all the orders are filled, who's left to buy? So, the more times support or resistance is tested, the weaker it becomes. Pro tip. Higher lows into resistance usually result in a breakout or ascending triangle. Lower highs into support usually result in a breakdown or descending triangle. Fourth, trading at support or resistance gives you favorable risk to reward. The big mistake traders make is this: entering trades when the price is far away from support and resistance. This requires a large stop loss and offers you a poor risk to reward. Here is an example. But if you let price come to you, then you'll have a tighter stop loss, and this improves your risk to reward. Remember, patience pays in trading. Stop chasing the markets and let price come to you. Pro tip. Mark out your support and resistance areas in advance. Then look for trading opportunities when the price has come to your levels. If the price is elsewhere, stay out. And now, how to tell when support or resistance will break so you don't get trapped. The takeaway is this. First, resistance tends to break in an uptrend. For an uptrend to continue, it has to consistently break new highs. Thus, shorting at resistance is a low probability trade. Instead, going long at support is a better trade. Second, support tends to break in a downtrend. For a downtrend to continue, it has to consistently break new lows. Thus, going long at support isn't a good idea. But, going short at resistance is a great idea. Third, support and resistance tend to break when there's a build-up. Consider this. Support is an area with potential buying pressure. So, the price should move up quickly, right? And now, what if price didn't move up and instead consolidates at support? What does it mean? Recall the concept from truth number 3. The more times support or resistance is tested, the weaker it becomes. So it's a sign of weakness as the bulls couldn't push the price higher. Perhaps there's no buying pressure, or there's strong selling pressure. Either way, it doesn't look good for the bulls and support is likely to break. Here is an example. And the opposite for resistance. A support and resistance trading strategy that lets you profit from losing traders. Here's a fact. Support and resistance attract a lot of attention from traders. There will be some looking to trade the reversal and others looking to trade the breakout. Since trading is a zero-sum game, for reversal traders to profit, breakout traders must lose. And for breakout traders to profit, reversal traders must lose. Do you understand? Good. Now let's learn a support and resistance trading strategy to profit from breakout traders. Here's what you need to do. First, mark your areas of support and resistance. Second, wait for a directional move into support and resistance. Third, wait for price rejection at support and resistance. Fourth, enter on the next candle with stop loss beyond the swing high or low. Fifth, take profits at the swing high or low. Here are other examples of the support and resistance trading to fully understand this wonderful strategy and to make the most out of it. You must understand this trading strategy isn't the holy grail. There are times you'll lose to breakout traders, and at times, breakout traders will lose to you. The only way you will survive in the long run is through proper risk management. Thus, I suggest risking not more than 1% of your account on each trade. As always, if you learned something new, or if you want more videos more often, make sure you subscribe, click the notification bell, and share this video across your WhatsApp, Facebook accounts, or Twitter to show your support. See you next time.